Despite all the noise and D.C. drama, my next guest sees several areas of opportunity in the U.S., in stocks and in bonds. Let's bring in Darrell Cronk. He's the CIO for Wealth and Investment at Wells Fargo Investment Institute. Darrell, welcome to you. Maybe I'll start with bonds. It's been a terrible stretch for them the last several years.
It has, Kelly. You're right. I think if you look at the Bloomberg aggregate, we're up 1.4% for 2024 for just straight U.S. Treasuries. That's when we were up 5.5% going into basically the fourth quarter of the year. So we gave a lot of that back. December was a really ugly month. I think the third worst on record in the last 45 years for Treasury futures. So we repriced the yield curve considerably.
But you would be a buyer here?
We're starting to extend duration here. We've been crowded to the short side of the curve. We're starting to leg out. We don't think you have to run and do that all at once. I think the key in 2025 here is you need both the 10-year Treasury and the unemployment rate to both stay below 5%. If that can happen, you're going to get some good economic growth. We've put 3 quarters in a row now in the books with 3% U.S. GDP growth. That's far better than the rest of the world. And remember, earnings are priced in nominal terms, right? So if I'm getting, call it 2.5% to 3% inflation, and I'm getting 2.5% to 3% GDP growth, I'm at 5.5% nominal. That's a really healthy environment for earnings, and I think for stock prices into next year.
And that's kind of where you're going. And I like how you said that we want both unemployment and bond yields to stay below 5%.
That's right.
Stocks, by the way, then do what? I mean, coming off a couple of strong years.
Yeah, I mean, obviously it's well documented. 2 years in a row, plus 20%. Hasn't happened since 1998. Only the 5th time in history it's happened. We set 57 new record highs for the S&P last year. So the bar is high coming into this year. But remember, almost all of 2023 was done through multiple expansion and virtually no earnings growth. It looks like when we ink the fourth quarter earnings here, as we step off in earnings season, we'll have somewhere around 9% earnings growth for calendar year 2024, which is healthy. And then next year, we're at 275 on the S&P. That compares to where we'll finish the year for EPS at probably 243, 244.
Wow.
So that's a healthy 12, 13% growth. We don't think multiples can expand from here because multiples are already high on a historical and relative basis. But if you get 12, 13% earnings growth, prices can go up in line with earnings growth, even if multiples stay the same.
Sure. I think a lot of people would take it. You're hearing, too, this kind of argument. It's contrarian to kind of go international, with a lot of people saying, how can it get any better for the U.S.? I mean, we continue to climb in terms of market cap. We know the challenges, rest of world, but once everyone's on one side of the boat, maybe we should think about why. You see how hard it is for me to even ask the question, is it possible that international stocks could outperform? Because I don't see it, but that tells you that maybe it'll happen.
You're right. And it's the right question to ask. Look, I mean, it's been asked every year for the last 5 years running, and every year it's been a value trap, right, to try to go internationally minus a few select markets. I mean, with Germany basically in a recession, France on the cusp of it, China having their problems with stimulus, the strong dollar, I mean, people are underestimating. When you look at what the dollar has done just in the last 90 days, it's in the 93rd, 94th percentile of moves historically for a strong U.S. dollar. That is just really hard on international markets and on international earnings. Can that abate and the dollar can kind of level off here and even come down a little bit into next year? That would be helpful for international companies. But right now, between rates going higher and the dollar going higher, it's really putting pressure on emerging market and developed market equities.
It's ironic because it sometimes puts pressure on us as well. So it seems nobody benefits from that strength.
That's right.
You have, I know you can't really necessarily give us specific names, but in terms of kind of themes, you're sticking with where the innovation is coming from, where the new growth is coming from, Gen AI, industrial power. Can you get any more specific on that, especially for some of these trades that already feel quite crowded?
Yeah, I mean, look, 2 years in a row, the 3 best performing sectors have been tech, communication services, and discretionary, right? So obviously they're not cheap. We do think that trend continues, although our most favorable right now in our portfolio is energy. We think energy is cheap. You're getting a solid dividend. Oil prices are back on the move higher. We're about pushing up to the 50-day moving average, could break through that. We also like industrials and we also like financials. So I think the story for equities in 2025 is both delivery of that earnings growth, but also a widening of breadth, which has been extremely narrow the last 2 years. You've got the top 6 stocks making up 31% of the S&P, top 10 making up 40%. You've got to get financials, industrials, some of these other areas that haven't participated as strongly the last couple of years to really help take the lead in 2025.
All right, Darrell, Cronk, thank you.